Good afternoon, viewers. My name is Varun Ratra, and we are Veye Pty Ltd. Thank you for tuning into our webinar. First of all, I would like to begin with our introduction. I want to tell everyone what exactly we do and who we are. So we are Veye Pty Ltd. We are an independent stock market research company. Our head office is based out of Kent Street, Sydney. We give general advice on Australian listed companies on what to buy, what to sell, when to buy and when to sell. We also cover US listed companies, predominantly NYSE and NASDAQ. This is mainly for Australian investors who are investing into the US equities. All right, so we've got a few topics on the agenda today. We'll go through those one by one. First, we have impact of rising interest rates and inflation on ASX. Then we'll talk about sector-wise performance so far, how the sectors have performed year to date. Then the third we have on the list is one defensive sector to look at during the uncertain times. So a lot of our subscribers have been asking us which sector they can focus during the time when the interest rates are going up. And then we're going to talk about top 3 ASX healthcare stocks for financial year 2023. And then we've got top 3 ASX dividend stocks for financial year 2023. The couple of things before we move on, I would like to introduce my fellow colleague, Ravish Srivastava. Ravish, just to give you a bit of introduction of Ravish, I'm pretty sure then he can talk about himself as well. Ravish has been with us for over 3 years. Ravish heads a sales team, and he knows the market very well because he has got good experience. And the best part about Ravish is that he works on these companies day in and day out. Hence, he's got quite a few companies on his fingertips. Hi, Ravish, how are you?
Hi, Varun. I'm absolutely fine. And thank you for giving a bit of an insight about the market initially. And, just to tell you about myself, I hold an experience of almost, 15 years in the industry. I have been there in VI right from the outset. And today we're going to talk about a lot of things which can give information to our viewers, to our listeners, and who can predominantly utilize this information in picking up, their stocks from there on. Let's continue, and we talk about a lot of things that you have highlighted.
Okay, great. So before we proceed further, I want to tell everyone that any advice we give is general in nature, without keeping in account your personal financial needs. Kindly refer to your financial advisor or broker for any further clarification with regards to our reports. Okay, so let's begin. All right, the first topic we have on the agenda is impact of rising inflation and interest rates on ASX. So in 2022, over the year, the interest rate increased from 0.1% to 1.35%. So it has been an increase of 125 basis points. As you can see the chart from April up till now, there has been a rise in the interest rates, and overall interest rates have risen by 125 basis points. So as you can see, the chart shows how Reserve Bank of Australia raised the cash rate by 50 BPS to 1.35% during its July 2022 meeting. The move followed June's 50 basis hike and a 25 basis increase in May, bringing the cash rate to a level not seen since May 2019. So now the next RBA board meeting and official cash rate announcement will be on the 2nd August 2022. We are anticipating that cash rate will again increase by 50 basis points. As you know that this spooked investors who had anticipated a hike of 25 to 40 basis points. and caused a massive sell-off in the markets in early June. So, as you know, that brought the ASX down, and the damage so far to the ASX is, as you know, that due to the penthouse demand and global supply chain challenges, inflation has been climbing in 2022. In Australia, consumer price inflation hit a two-decade high of 5.1% in the first quarter of the year. And during the Reserve Bank of Australia June policy meeting, Governor Philip Lowe said that higher prices for electricity and gas and recent increases in the petrol prices mean in the near term inflation is likely to be higher than what was expected a month ago. Since the start of 2022, the ASX 200 has fallen by almost 12%, starting the year at 7,590 points, and having last closed at 6,650 points. As in, this data is up till 14th of July. ASX, the lowest has been the last, it was down to 6,433. That was the lowest in the last 20 months. All right. So, Ravish, let's go through the sector-wise performance so far, and what sectors have delivered year to date, and what their performance has been up till now. All right. So, this sector-wise performance data is from year to 12th of July 2022. So usually there are three industries that compose the majority of the ASX 200 are financial services, materials, and healthcare. So financial sector, if you look at ASX 200 financials, the sector overall is down 11.42% year to date. Okay, and the second one is material sector. Material is down around 14.24% year to date. And then we've got healthcare sector, which is down 3.13% over the year. So healthcare sector is relatively immune from inflationary pressure compared to other sectors. Healthcare has shown fairly good results. And then we've got energy sector. Energy sector, due to conflict between Russia and Ukraine, oil and gas prices are up, as you know, this year. And on the back of this, energy sector has jumped almost 19% over the year. And the most beaten down sector, apart from technology, we have got real estate sector. So rising interest rates, as you know, are not a favorable. They're not good for real estate, and overall real estate is down 22% over the year 2022. And so this is what we've got from sector report. And then now coming on to the defensive sector that one can focus on. So one defensive sector we're going to talk about, and we think that this because the point is investing will never stop. People will keep on investing, and during this time they need a sector they can rely on, sector that is recession resilient, sector that can perform well. So as you know, the stock market corrections affect all the sectors, though in varying proportions. Some of the sectors are resilient and generally remain stable during markets fall. According to us, the healthcare sector has the potential to be long-term play as industry consolidation and demographic facilitate growth. As you know, the healthcare is a defensive sector because these companies offer products or services that consumers will still need to buy in hard times. After all, healthcare is a primary concern, and people still visit doctors and refill their prescriptions even when they can't afford other goods. Okay, so let's begin talking about three companies from healthcare sector. and we believe that these companies are pretty strong. Three interesting companies we're going to talk about, and we believe that anyone looking for a medium to long term time horizon, we think these companies can perform really well. Okay, Ravish, very interesting company. I really like it, and we believe this company has got a potential. And the company that we have is the first company is Immugene Limited. The code is IMU. Immugene Limited is an Australian-based clinical stage immuno-oncology company, and they are engaged in developing immunotherapies that seeks to activate the immune system of cancer patients to treat and eradicate tumors. So that is Immugene that we have. And Immugene is as I mentioned earlier, that Immugene is in immune oncology therapies with a rich pipeline and prospects. And recently, they received the approval from Human Research Ethic Committee, which is HREC, to initiate a phase 2 clinical trial of its immunotherapy candidate, HER-Vax, which is HER, in Australia, which is a significant milestone for immune and clinical treating Australians faced with the challenge of HER2. And plus, they also treat gastric cancer. So now the best part about Immugene is that they've got $100 million in cash. So that makes this company the most financially secured biotechnology companies on the ASX. Having 3 unique platform technologies supporting 6 unique assets on Carlistics, CheckVac, PD1Vax, CF33, and HER-Vax. So within 12 months, it expects to have 10 clinical studies supported by 5 to 6 FDA's INDs, which is investigational new drug. The best part about Immugene is they're targeting almost 10 diseases areas, and then apart from this, they're also targeting supply agreements with leading pharmaceutical companies and having to industry scientific collaborations already. Apart from this, now the stock right now, they're trading at 25 cents. So what we believe that 25 cents is a decent price to look at Immugene. We've covered this stock at around the same price, and we've given a buy. And we believe that anyone looking for a medium to long-term view can consider this stock, and we think they can perform well. Okay. And now coming on to the second company that we have in place now in healthcare sector, that is Pro Medicus. So Pro Medicus is an Australian-based healthcare informatic company. They are actually a developer and a supplier of healthcare imaging software and services to hospitals, diagnostic centers, imaging groups, and other related healthcare entities in Australia. So the best part about Pro Medicus is an increasing number of Visage clients. So Visage is a wholly owned subsidiary of Pro Medicus Limited, where they're providing a fully cloud-based solution, a trend that has taken a major foothold in the North American healthcare IT sector. PME, the code is PME for the company. PME's proven cloud engineered technology provides it with a very significant strategic advantage, with the last 6 of its major contacts being cloud-based. Even Goldman Sachs believes that Pro Medicus is the clearest beneficiary of artificial intelligence algorithms and have upgraded PME. So even recently, Goldman Sachs have upgraded their rating. And the best thing about PME is it has given a substantial return over the period. We recommended PME at a very good stage. We initially picked them back in 2018 when they were trading at around $10. Since then, it has given almost more than 300% return. Even at $38, we saw another opportunity. We covered another report on PME, and we had given a buy on it at $38. I think somewhere around $38. And now the stock is trading around $49. And we believe PME has got more upside potential from here. So again, do not consider stock for a short term, because anything can happen in a short duration. As you know, that markets are volatile, and hence anyone considering a PME can look for a medium to long term. Okay. So third company, Ravish, would you like to talk about the third company now?
Oh, yes, sure, Varun, and thank you very much for highlighting the healthcare sector altogether. See, the healthcare sector basically, has a lot of prospect, right? And the best thing about healthcare sector is that these companies, which are healthcare, they are basically into the defensive sector altogether. So even if we see the markets going up or going down, we could see these healthcare companies performing well. And that's what we have seen even during the pandemic, right? When COVID was there, we saw a few healthcare companies, performing well. We saw CSL doing well as well, right? Now, I'm going to talk about the third companies. You've highlighted about ProMedicus. You've highlighted about Imugene. Now we're going to talk about a biopharmaceutical company, which is called Clinuvel Pharmaceuticals Limited. To our listeners, the ASX ticker or ASX number, what you call is CUV. So that's C for Charlie, U for umbrella, and V for Victoria. And if we look at the current price of Clinuvel, yes, they have dropped a bit in the last few days, but that's understandable because of the market conditions. We can see these companies correcting a bit. But when you hold a company like Clinuvel for a longer time, this could reap benefits. And we had given a buy on Clinuvel Pharmaceuticals at a price of roughly close to $16.46 last month. Now, if I talk about Clinuvel, they are basically into pharmaceuticals, which is treating life-threatening disease like the acute disorders. And Clinuvel is focusing for genetic and skin disorders. So they've got this product, which is Senesis. And Senesis is a product which is basically for preventive therapy. And that has a substance which is acetate. So this is what is driving the revenue for Clinuvel. Now, if I talk about the financial performance of Clinuvel, the group recorded for the first time, cash equivalent of roughly about $100 million. Now, that's a good buffer if you talk about the financial status. If I talk about the revenue, I think back in 2016, they were clocking roughly 7 million. And now last year, I think they had released the figure of $48 million. So that's a jump of almost like a 600%. The company has jumped almost 7 times in terms of revenue. If we talk about the profits, they were not generating anything back in 2016. I think they were negative 3.2 million. Now they're doing almost like a 28 million. So Varun, I think, they've got tremendous financial results, right? And Clinuvel in future can do really well because of one of their products, which is Senesis. They have their presence in Europe. They have their presence in US and Israel as well. They're conducting trials even right now, for life-threatening acute disorders. If the skin is exposed too much to sun, it can cause, lethal disorders, even in that matter, skin cancer. So Clinuvel, we really like them as one of the biopharmaceutical companies. And, I would agree that even Imugene and ProMedicus, along with Clinuvel, can be extremely good opportunities for our listeners.
Rightly said, Ravish. Clinuvel, yes, I know this stock. I have been watching it for a long time. And yes, their product Senesis is very popular, especially in Europe. And I remember I saw Clinuvel even touching $44 at one stage. And there has been a correction since then. and we believe that they have been oversold. So now at the current price, I think they're trading at around, I think below $17, slightly below. And from that price, we see a buy opportunity. So we reckon that CleanerWell is a strong company on the back of increasing revenue, on the back of the sale of Synesy, and we think they can do really well. Okay, brilliant. So now let's move on to the three dividend stocks for 2023, financial year 2023. And we think that these companies are really good. Anyone looking for regular dividends, anyone looking for a bit of growth can look at these companies. But again, just to remind everyone that that dividends are subject to the discretion of companies. They can defer, they can cancel dividends in future. And however, looking at the balance sheet, looking at the financial of these companies, and looking at the history, they have been pretty consistent with paying dividends, and most likely they would continue paying dividends in future as well. So let's talk about dividend stocks. Okay, so Ravish, would you like to start with the dividend stocks?
Oh, absolutely. Thank you. And as you rightly said, Warren, the best thing about dividend companies is that investors can expect a set of return, right? So we should always go for some income stocks, which are good in their values. The financials are good. And my pick, would be the first one with Money3. So, if you people are aware, Money3 is basically an Australian company which is into consumer and commercial finance, right? So Money3 specializes in a provision of finance to purchase of new or used vehicle, like you can go for cars or vans or utility vehicles, scooters, even people buy jet skis and, caravans. So this is basically offering unsecured personal loans to consumer. Now, when it is unsecured, it brings a lot of users to it because there is no collateral involved. And Money3 has three major brands. So Money3 is one of the brands. Then they have automotive financial services. And then they also have Go-Car Finance. Now, if I talk about the dividends, the dividend is roughly about 8%. And that has 100% franking. So that's a very good thing, listeners. Fully franked dividends are always attractive because they can take care of the taxation portion. Now, the financials of the company is looking good right now. And that is basically, if I talk about the group revenue was up almost 30%. Now that's staggering. They were touching roughly about $140 million. Even if I talk about the net profit after tax, they have been showing a profitable growth. The year-to-date return was up almost 37%, right? They've got a strong cash flow and they have been obviously taking care of the bad debt. So Money3 is one company, which can do well. The ASX ticker on Money3 is MNY. I'll repeat, this is MNY. And as I talked about, the revenue, the net profit after tax has grown. And we saw a huge surge in the new loan originations. If I talk about the new loan originations went up by almost 57% for the company. And we are expecting a growth of roughly about 7% for MNY in the next 12 months. So the industry has been growing significantly, and that is what has been driving Money3. So they have been in the industry for almost like 20 years in lending and collecting, right? And by streamlining the borrowing process, market players have now access to financial financing, right? So MNY is a good one for a longer time. Anyone who is buying it, should eye roughly about 12 months or 14 months timeline for MNY. And there's a huge opportunity in the market with approximately 20 million vehicles in Australia. And that has been increasing approximately 2% annually. So we had recommended a buy on MNY in a couple of months ago, right? And we still are bullish about the company as of right now. If I talk about, they are trading at a price of roughly $2.15. And that is one company in dividends, which I really like. So why don't I think you should be agreeing with me on MNY. That is something that users and listeners can pick up.
Absolutely, Ravish. MNY, Money 3, because, I mean, as you know that people know about big companies like BHP, ANZ, and Commonwealth, but companies like MNY, they have been obscured. However, if you look at these companies, they have been the most productive companies in last few years. And yes, anyone looking for consistent dividends, anyone looking for a bit of growth can look at MNY. We have done extensive research on this company, and looking at their financials, looking at their balance sheet, we believe that they can produce good returns over the period. Okay, so now let's move on to the next stock that we have on our list. So, Ravish, which one is the second company?
Oh, yes. Thanks very much. And the next company which we would like to pick up, and after doing the extensive research, we found that Corvus Limited could be an extremely good choice. So the ASX ticker on Corvus, listeners, you can write it down, is KOV, right? And anyone who is looking for dividends, this is basically for low to medium risk, right? So this does not have very high risk. So that's very good. If someone is putting their money on Corvus, they can look for a return, and the risk is also low to medium. This is not a very big company. Corvus, if we talk about, they're roughly about $86-87 million company, but they have been there in the business for a long time. If I remember correctly, I think they originated somewhere in 1970s, right? And why they became basically popular is because of easy strut. So they are into galvanization services, right? So they are into galvanization, hot galvanization for sheet metal fabrication. They manufacture cable and pipe support systems and fittings. And that is one of their brands, which is Easy Strut. That has been that has been a really good driving force for Corvus. Now, Easy Strut, if we talk about, is a leading range of cable and pipe support system in Australia, right? They manufacture one of the most diverse range of cable and pipe supports in Australia, which is being widely used by a lot of players who are into industrial sector altogether. So cable and pipe supports are the backbone of construction, mining, infrastructure, and Corvus is the only major Australian-owned cable support company which is manufacturing most products in-house. So they're not outsourcing. They have their manufacturing plant, and that is basically manufacturing all these products to supply to the users. So Easy Strut and Corvus Galvanization are the two brands that Corvus company is holding, and they're providing solutions to mining, petrochemical, food processing, oil and gas. And if I talk about the financials, the revenue from trading operation has gone up by a staggering 60%. Now they are doing approximately 51 million, right? And that is basically concentrating on large project work in industrial product segment. On a long term, the chart has recovered more than 80% on a fall. I think it fell down back in February 2013 from a high of approximately $8. Now, continuously they've been under selling pressure, but now they have maintained stagnancy in the price. And now we think if we talk about the longer term, we are holding a bullish view on them. And there has been a high formation on the technical chartings. So if you look deep into the technical chartings, we can see this has bullish view of the stock. And with the charts confirming the upside movement, we are really looking forward for Corvest, but with a time span of roughly 3 to 5 years. So anyone who is looking for next 3 to 4 years, because we get a lot of queries, Varun, from our members that they want to buy something for 3 to 4 or 5 years horizon. They're not looking for short-term gains. So anyone who's looking for a longer horizon, KOV, at a price of around $8.10 currently, it could be an extremely good dividend company to look at.
Right. Great insights on CoreVest. Thank you, Ravish. Yes, I mean, the price right now is $8.10. And today they are up 8% as we are talking now. The best part about CoreVest is it has delivered good returns already up till now, and they are nearly to their 52 weeks high, which is their 52-week high has been $8.30. And yes, we believe they're starting another leg up, and on the technical charts, the company looks pretty strong. And yes, the dividend yield is around 5.56% on the current price that we have. And yes, it's a fully franked dividend. So we do really like this company, and we think anyone, as Ravish has mentioned, that anyone looking for a 3 to 5 years time horizon can consider CoreVest. And the ticker is KOV. All right. So the last company for dividends, we have got Detra Royalties. Detra Royalties, the code is DRR. A very interesting company to look at, and especially their business model. Please look at this company, and why we like Detra, because Detra is a type of business that gets revenue in the form of royalty from asset revenue. Asset revenue line. Asset means the mine for which DRR has provided the funding. In exchange of this one-time funding, DRR gets a fixed share of future production revenues. The best part about DRR is that Detra does not incur any operational expenditure, but can capture future upside. The best thing, and the other factor which is there for Detra is investors are exposed to lower capital and operating risks, but retain further future upside benefits when the mine goes for expansion or enhances production. Again, Detra had 3 producing royalties in the month of March 2022 quarter, comprising mining area CMAC, which generated iron ore revenue royalties of $59 million, and 2 Western Australian mine sand operations, which generated almost $100,000 combined. So Mike, it's MAC Royalty covers a world-class iron ore hub operated by BHP, the world's largest mining company, as you know. Okay, and so we really like Detra. Detra looks pretty good, and the best thing is Detra pays a really good dividend, and right now the stock is trading above $4. The exact price as of today for Detra is, I'll just bring it up here for you, which is $4.25 as we are talking now. And the dividend yield is really good. It's around 5.5%, and that is just checking if it's fully franked. Yes, the dividend yield is fully franked. So very interesting company, and a very strong business model this company has. And this is our third and the final company from dividend space. So we think these are the companies with a decent dividend yield, have got potential to perform well. So this is for our viewers. When you get a chance, you look at these companies. All right, guys. And now, if you have any queries, any questions, you can always email us, and we are contactable on info@veye.com.au. That is veye.com.au. Or you can call us on our board line number, which is 0290254957. Okay, we are signing off now, so thank you very much. If you want to visit our website, you can always do that. Our website address is veye.com.au. There, if you want to leave any comment, you want to reach us out, you can always do that. You can also click on our subscribe page. There you can find out the reports we offer and what are their prices. Thank you.